Let's return to the commodities story. The question right now is whether the rising prices we see today for everything from silver to oil mean last week's sell-off is over. Here to help answer that question is Michael Shaoul. He's chairman of Marketfield Asset Management, a New York-based firm that oversees about $1 billion. Michael, thanks for being here early in the morning. Why don't we start with this? Is the rout over? Is that what the prices we see this morning are telling us?
No, I don't think so. Actually, this looks like a textbook top. If you went back to, say, 1980 and looked at how silver behaved, it peaked at almost exactly $50. It fell back down to about $36 very quickly and made its way back to the mid-40s. You had a very similar kind of performance in the NASDAQ in 2000, where we peaked at about 5,100, fell to the mid-3000s, and made our way back to the mid-4000s. So far, it actually looks like a very typical important top being put in place.
So this will be a very brief respite, and what you were saying, I take it, is that commodities will resume last week's declines and continue further down.
Yeah, I think that's the most likely outcome at this point in time.
Have you any idea, can you say, based on the charts you're looking at and historical performance, how much further they might have to go?
Well, I think some of them will go down a lot. If this is a major top, you can have losses in excess of 50%. That would be very normal.
And where might we see, it's not going to happen across the board, which commodities, in your opinion, are most likely to drop the furthest?
Well, I think I would say the soonest first. I would say that the agricultural sector, and I think you'd need to put silver fairly near the top of the list. I think that, even if this was a major top across the complex, it's still possible for some of the larger commodities to go on and make new highs before they, join the corrective move down.
When you say commodities, agricultural commodities specifically, are we talking about what? Cotton, for example? Cotton is among the few declining again this morning.
Well, it's not a good sign to be down today, I would say that. Anything which is down today gets a big question mark against it. But you had a fairly euphoric move into agricultural commodities earlier on this year, and most of them are significantly below their 2011 highs already. So it's pretty much across the board in the agricultural sector.
Now, the fundamental explanation for this is what? They're just the supply-demand balance or imbalance, if there is one, doesn't explain in and of itself the prices we see in the markets.
No, it never does. When you have a major top put in place, the fundamentals always look wonderful. I think the fundamentals for commodities are good, but I think that financial flows have completely overwhelmed any fundamental excuse to be involved.
So what's going on in the portfolios themselves? Investment managers are making decisions to sell commodities. The question ultimately is why? Is it because of these rising margin requirements at the futures exchanges, or is there something deeper?
Well, I think that last week's break was caused by a rise in margin requirements, and what that set off was a sell-off of such magnitude that it wasn't necessarily the portfolio manager making the decision. It may have been his boss, it may have been his margin clerk. If you're talking about an individual, it may have been his spouse.
Right. Okay, so it's a risk management exercise, effectively?
Yes, I think what you saw last week was risk management, which got somewhat out of control for a couple of days.
Okay, now, if risk management ultimately is deciding the day, surely there is a point, I say surely only because I imagine it to be thus, that there is a point at which risk management will no longer require these portfolio managers to be selling. So what exactly is it that is going to drive the commodities down as far as you anticipate they may fall?
Let's use the example of silver, because I think it's the most interesting. If you look at silver, it pretty much went up in a straight line from $30 to $50. All along the way, you'll have had people wanting to get in, wanting to get in, wanting to get in, and other people wanting to get out. You reached this point last week where simply more people wanted or needed to get out than wanted to get in. Now you've sort of reset the clock. You have silver back down to $35. I'm sure there's a whole bunch of people out there who think silver's a wonderful place to be, $35. When it gets to $45 or $46 or wherever the magical point is, all the people who wish they got out at 50 suddenly overwhelm the people who want to get into wanted to get in at 35. And this is really the way that major tops get put in place. I might be wrong. Silver may go through 50 and go up to 80. But
of course you may be wrong, and that ultimately is the last question. If the decline, if there's anything that's going to come about to stop commodities from falling, what might it be?
Simply even more enthusiasm than we see today.
Driven by any particular catalyst? Middle Eastern tensions, the flooding in the Mississippi?
No, I think what happens is you have the move in price, and then you have the excuse attached to it.
Right, so it just feeds on itself effectively.
Exactly.
It becomes a momentum trade.
Exactly.
All right, Michael, thanks for being here.
Pleasure. Thank you very much.
Good to have you. Michael Shaoul, he's the chairman of Marketfield Asset Management, oversees some $1 billion here in New York City.